You're watching Old and Broke. October 19th, 1987. The Dow Jones bleeds 508 points in 6 hours, 22.6%, still the worst single-day percentage collapse in Wall Street history. Traders screamed, algorithms whispered, panic won. Fast forward to March 2020. A virus leaps from Wuhan to Wall Street. 34% vanishes in just 23 trading days, the fastest bear market ever recorded worldwide. Then Wall Street performs its familiar miracle. Record highs while Main Street nails plywood over broken dreams. 2 crashes, 33 years apart. One sparked by machines, the other by contagion. Different triggers, same prescription. Privatize the winnings, socialize the losses, stamp it capitalism, and move on. Here's what they'll never tell you. Every crash since 1929 has followed the same script. New costumes, upgraded technology, more zeros. But the demolition crew behind the curtain, they never change. They just cash bigger insurance checks. The 1920s discovered the perfect wealth hack. Leverage. Buy $100 in stocks with $10 cash and $90 in dreams. By 1929, Americans had borrowed $8.5 billion to play the market. That's 10% of the entire economy betting on numbers going up. Here's the beautiful part. When you're 90% leverage, you need just an 11% drop to lose everything. October 29th, 1929 delivered exactly that. A 12% single-day massacre that turned millionaires into breadline statistics. 25 years. That's how long it took the Dow to recover. A generation wiped out so the next one could make the same mistake with better technology. The lesson is simple. Leverage doesn't create wealth, it transfers it. From the impatient to the patient. Here's how the numbers looked. Margin debt exploded through the 1920s, hitting $8.5 billion, nearly 10% of the entire US economy. That was leverage stacked like dynamite under the Dow. On Black Tuesday, the market fell 12% in a single day, wiping out anyone who had borrowed their way in. Unemployment later peaked at 25%, and the Dow, it didn't recover until 1954, 25 years later. That's how leverage works. Fast riches on the way up, a lost generation on the way down. August 15, 1971. Richard Nixon walks into the Oval Office with the biggest theft in human history. In one TV appearance, he steals the world's monetary anchor, gold, and replaces it with government promises. We're temporarily suspending convertibility, he lied. 44 years later, temporary became permanent. 2 years after Nixon's heist, OPEC proves what happens when money becomes worthless paper. Oil jumps from $3 to $12. Gas lines circle cities. The Dow falls 45% while inflation hits double digits. Stagflation, the economic aids of fiat currency, is born. The new rulebook? Print first. Ask questions never. The lesson is clear. Remove the anchor and every storm becomes a hurricane. The cyan line shows oil prices surging from $3 to $12 a barrel after the 1973 OPEC embargo. The red line tracks inflation, which rises sharply to around 11% by 1974. Meanwhile, the green line marks the Dow Jones, falling nearly 45% between 1973 and 1974. Together, these moves created stagflation, rising prices, falling growth, and a broken economy that no policy could easily fix. Wall Street's next innovation, robot greed. Portfolio insurance. Algorithms programmed to sell when prices fall. It was supposed to be a safety net. Instead, it became a suicide pact. October 19th, 1987. Computers start selling. Prices fall. Computers sell more. Prices fall faster. Computers sell everything. 22.6% evaporates in 6 hours because humans program machines to panic better than they ever could. This wasn't fear. It was a feedback loop, an infinite mirror of selling, reflecting back on itself until the market consumed its own shadow. Enter Alan Greenspan, stage left, with a printing press. The brand new Fed chairman floods Wall Street with fresh cash. Markets recover, crisis solved, moral hazard created. From now on, every crash gets a bailout. Every mistake gets a do-over. Every loss gets socialized. The lesson: when machines cause crashes and central banks fix them, who needs consequences? The cyan line shows the Dow Jones dropping 22.6% in a single trading day on October 19, 1987, the steepest one-day loss in history. Automated selling programs amplified the decline, locking investors into a downward spiral. By early afternoon, nearly a quarter of the market's value had been erased. Then Federal Reserve Chairman Alan Greenspan stepped in. Liquidity injections reassured banks and markets, and prices rebounded by the close. Black Monday didn't end the system. It marked the beginning of the bailout era. The late 1990s discovered something beautiful: story-driven investing. Forget profits. We're buying the future. Pets.com burns $300 million marketing dog food online, generates $619,000 in sales. Investors call it disruption. Webvan raises $800 million to deliver groceries, then discovers groceries cost more than venture capital. The company dies. The lesson lives forever. The NASDAQ climbs 400% in 5 years because the internet changes everything. Then crashes 78% because math still exists. $5 trillion in market value evaporates like a bad PowerPoint presentation. But here's the genius. The internet survives. Amazon survives. Google is born in the wreckage. The technology was real. The valuations were performance art. The lesson: fiction can drive markets higher than facts until fiction meets math. The cyan line shows the NASDAQ's rise from under 1,000 in 1995 to over 5,000 by early 2000, a 400% surge in just 5 years. Much of that growth came from companies with little revenue but enormous promises. When those promises failed to deliver, the bubble burst. Between 2000 and 2002, the NASDAQ collapsed 78%, erasing about $5 trillion in market value. Most dot-com startups disappeared, but the internet itself did not. Out of the wreckage, companies like Amazon and Google endured and went on to define the next era. Wall Street's masterpiece: weaponized complexity. Mortgages became securities. Securities became derivatives. Derivatives became derivatives of derivatives. Each layer added fees for bankers and confusion for everyone else. The pitch was elegant. We've mathematically eliminated risk. Rating agencies stamped AAA on securities that would lose 90% of their value. Pension funds, foreign banks, your grandmother's retirement account. Everyone bought the lie. September 15, 2008. Lehman Brothers, 158 years old, $639 billion in assets, dies overnight. The Dow falls 54%. Global trade freezes. Ben Bernanke's response: $700 billion in direct bailouts plus trillions in secret Fed programs. Banks get rescued. Executives get bonuses. Families carry furniture to the curb while bankers carry bailout checks to their boardrooms. Moral hazard becomes monetary policy. The lesson: the more complex the scam, the bigger the bailout. The cyan line shows mortgage debt climbing through the 2000s, peaking near $11 trillion by 2007. The red line, the Dow, tracks the market's fall, plunging more than 50% as the crisis unfolds. Meanwhile, the green line, unemployment, jumps from about 5% in 2007 to 12% by 2009. At the bottom, the gray bars show bailouts: $700 billion in TARP, plus trillions more in Federal Reserve support. The outcome: markets were stabilized, but households bore the collapse. March 2020, the fastest bear market in history. 34% gone in 23 days because a virus shut down human contact. Jerome Powell's solution: the fastest money printing in history. Zero rates. Unlimited quantitative easing. $3 trillion created from thin air. In weeks, not years. The result? Wall Street hits record highs while Main Street boards up windows. If you owned stocks, houses, or Bitcoin, you got rich. If you needed a paycheck, you got poor. 2020 proved crashes don't destroy wealth. They redistribute it, from workers to owners, from renters to landlords. from savers to speculators. The lesson? Crashes are wealth redistribution events disguised as natural disasters. The red line shows the S&P 500 falling 34% in just 23 days, the steepest and fastest collapse ever. The green line tracks unemployment, spiking to nearly 15% as tens of millions lost their jobs. Meanwhile, the cyan line, the Fed's balance sheet, jumps by more than $3 trillion in a matter of weeks as Powell launched unlimited quantitative easing. Markets rebounded almost instantly, even as unemployment stayed high. The data makes it plain. Stimulus flowed into assets, not households. Every crash teaches the same lesson in a different language. 1929. Leverage amplifies everything, including stupidity. 1973. Remove the anchor, embrace the storm. 1987. Automate greed, systematize panic. 2000. Sell dreams, collect reality checks. The pattern isn't repeating, it's evolving. Each crash gets bigger, each bailout gets faster, each generation gets poorer, while each rescue gets more expensive. Every crash isn't a failure, it's training data. The system is learning how to crash better, faster, and more profitably. We're not learning from history, we're perfecting it. The lesson: history doesn't repeat, it compounds. 2008, complexify crime, socialize punishment. 2020, print money, preserve wealth inequality. The red bars show market losses from 6 major crashes. 1929, down 89%. 1973, down 48%. 1987, down 34%. 2000, down 49%. 2008, down 57%. 2020, down 34%. The green line shows peak unemployment, 25% in the Great Depression, 10% in 2008, and nearly 15% in 2020. The cyan line tracks bailouts as a share of GDP, tiny in early crises, then exploding to 15% in 2020. Recovery times shrink from 25 years in 1929 to just half a year in 2020. Not because markets healed faster, but because interventions got larger and quicker. The pattern is clear: bigger crashes, bigger rescues, shorter recoveries. Today's economy is every previous crash having a baby together. Global debt, over $300 trillion, 3 times world GDP. U.S. corporate debt, more than $11 trillion in IOUs. The derivatives market, over $600 trillion in imaginary money. Money supply growth, 40% in just 2 years. We've combined 1929's leverage, 1973's fiat printing, 1987's algorithmic trading, 2000's narrative bubbles, 2008's complexity, and 2020's instant bailouts, all in one system, all at the same time. Central bankers face the same impossible choice their predecessors faced: crash the economy or crash the currency. There's no third option because there never was. The lesson: when you combine every failure mode in history, you don't get safety, you get amplification. The red bars show debt. Global debt now exceeds $300 trillion, nearly 3 times world GDP. U.S. corporations owe over $11 trillion. Households carry about $17 trillion. The orange bar represents derivatives, $600 trillion in notional value, dwarfing the size of the real economy. The cyan bar shows money supply growth, up 40% in just 2 years. And the purple bars capture the shadow system. $65 trillion in shadow banking assets, $25 trillion in central bank balance sheets, and $1 trillion in annual U.S. interest costs. Together, these numbers reveal an interconnected structure where pressure in one area can destabilize everything. Here's what a century of crashes teaches. They're not accidents. They're the business model. Crashes don't happen to the system. They are the system. Wealth flows upward during booms, gets concentrated during busts, then gets preserved during bailouts. The house always wins because the house writes the rules. Every generation discovers the same truth. This time is different. Every generation learns it's exactly the same, just with more zeros. In a century, crashes have erased over $50 trillion in wealth. Every dollar found a new owner. None of them were you. The dominoes are standing. 1929, 1973, 1987, 2000, 2008, 2020. The next one is already carved. It just hasn't fallen yet. The only question isn't when. It's who's holding the bag when the music stops. And if you think the story ended in 2020, look at the ledger they've already drawn for 2029. The red bars show total wealth lost in major crashes. 3 trillion in 1929, 2 trillion in 1973, 1.5 trillion in 1987, 6 trillion in 2000, 15 trillion in 2008, and 20 trillion in 2020. But the gold line shows who came out ahead. The top 1% increased their wealth share from 24% in 1929 to 40% by 2020. Meanwhile, the blue line, the bottom 50%, slipped from about 3% of wealth in 1929 to barely 1.5% today. The pattern is unmistakable. Every crash accelerates concentration. Losses are socialized, gains are privatized, and the gap only widens. The debt clock doesn't lie. It just runs faster than we do. Today, U.S. national debt sits near $37 trillion. By 2029, even the official projections admit 43 to 47 trillion. Annual interest alone, over 1.7 trillion, larger than the defense budget. That's the endgame math. A government borrowing money just to pay the interest on the money it already borrowed. The line between debt and default is no longer a wall, it's a blur. Meanwhile, the scoreboard of real money tells its own story. Gold, $3,683 per ounce, climbing parabolically. Silver, breaking $42 per ounce, finally waking up after a decade of sleep. Platinum, pushing $1,400 per ounce, undervalued yet rising with the tide. That's not investment advice, that's monetary archaeology. Every ounce is a receipt that governments can't debase. Every tick upward is a footnote proving the dollar's decline. We've seen this movie before. 1929, 1973, 1987, 2000, 2008, 2020. But the next act isn't just another crash. It's the reckoning when debt, currency, and confidence break at the same time. The lesson: history's demolition crew didn't retire. They just passed you the bill. The forecast isn't about timing the next crash. It's about recognizing that the future ledger is already written. The future isn't uncertain, it's accounted for. You're watching Old and Broke. We don't predict the future, we just pay attention. Hit like, hit subscribe, stay sharp.